Welcome to the Explainer. Okay, I want you to picture this. You and I are sitting right now across a polished mahogany desk in my office. You're an American expat, your bags are basically packed, and you are getting ready to live out your dream retirement over in Europe. But listen, right before you board that flight, we need to have a very serious, high-end tax briefing about your financial portfolio. Because you've worked hard for decades, right? You've diligently funded that Roth IRA, and you are understandably super proud of that pristine, seemingly impenetrable U.S. tax shield you've built up. You're probably sitting there thinking your tax-free withdrawals are guaranteed no matter where you go. Okay, let's dive into this. Because, well, probably not. I've got to deliver a bit of a stark reality check here. For the vast majority of European countries, the exact moment you cross the Atlantic and establish tax residency, that beautiful U.S. tax shield is just stripped entirely away. To really understand why, we have to look at what's called the global default rule of international taxation. Basically, your new country of residence gets the fundamental right to tax your worldwide income. That includes your pensions. And here's the really hard truth. European tax authorities literally do not care what the IRS considers tax-free. The whole concept? Most countries just do not recognize the unique status of a Roth account at all. So let's look at what actually happens on the ground by examining 3 very different European destinations. Section 1. Spain, the brokerage downgrade, losing your tax-sheltered status entirely. So if you're planning to enjoy your retirement sipping wine on the Costa del Sol, we really need to prepare for a bad news scenario. And this brilliantly illustrates the core conflict. In the U.S. view, your Roth is obviously a tax-free pension, but Spain's view? Yeah, they reclassify it completely. Spanish tax authorities do not recognize the Roth as a tax-sheltered vehicle. Instead, they treat it exactly like a standard brokerage or investment account, which means the profits and gains you withdraw are not treated as exempt pension income. They're hit with Spain's capital gains tax, which they also call the savings income tax. And the complications in Spain don't stop at withdrawals. 50,000 euros. If the balance of your Roth IRA exceeds this specific threshold, you suddenly trigger Spain's incredibly strict Modelo 720 reporting requirement. Failing to report this properly carries some really severe penalties. Furthermore, because Spain views this as an investment account, the full market value of your Roth IRA is exposed to the Spanish wealth tax, which gets calculated every single year based on the specific region you live in. Moving on to Section 2, Switzerland, the financial downgrade. Strict rules and complex criteria. Now, if you had a traditional IRA, it might actually survive the transition and be treated as a pension. But Roth IRAs, they face rigorous Swiss bureaucracy. Swiss tax authorities use this incredibly strict 6-point test to see if your foreign account matches their domestic individual pension plans, which they call a Pillar 3A account. They demand to know the whole shebang. Are the assets permanently tied up until retirement age? Is it linked to gainful activity? Are the contributions strictly limited? Is it financed only by the employee? They scrutinize literally every single detail to determine equivalence. And here is the punchline for our briefing today. Roth IRAs completely fail the Swiss test. Unlike traditional IRAs, which broadly do meet those criteria, Roth IRAs cannot be recognized as equivalent to a Swiss individual pension plan. And because of this failure, your Roth IRA is heavily downgraded, losing all of its pension protections. The ridiculously costly consequence of failing that test is reclassification. Switzerland officially categorizes your Roth IRA as a taxable financial product, or sometimes an insurance product. This means the returns and gains are taxed as ordinary income at your standard progressive rate. Plus, exactly like in Spain, the assets in the account are generally subject to the Swiss wealth tax, even if you haven't made a single withdrawal. Crazy, right? All right, Section 3, France. The treaty loophole. The golden exception for American retirees. Okay, take a deep breath because we're arriving at the climax of our briefing, and it actually comes with a massive sigh of relief. France is the rare golden haven in Europe where your U.S. tax shield actually holds up. This happens because of a beautiful structural accident in the U.S.-France tax treaty, specifically Articles 18 and 24. See, while the U.S. retains the exclusive right to tax your pension, France technically claims the right to tax your worldwide income. But to avoid double taxation, France grants you a tax credit equal to the full amount of French tax that would otherwise be owed on that U.S. source investment income. It works like magic. Like it says right there, the credit effectively zeroes out the French tax liability on your U.S. pensions and even certain U.S.-sourced dividends. But as your advisor, I absolutely must warn you about a crucial caveat. We call it the toto-fictive trap. Even though your Roth income is practically exempt from French tax, you are still legally required to report it on your annual French return. France uses this total worldwide income to calculate your effective tax rate, the totos effective. So while the Roth money itself isn't taxed, its mere presence on your return can push your other French source income, like say local rental income or a French pension, into a significantly higher tax bracket. So the crucial point really comes down to this vastly different reality for a hypothetical American retiree. Look at how this breaks down. Cross into Spain and you're hit with capital gains and wealth tax. Settle in Switzerland and you face ordinary income tax and wealth tax. Retire in France, and through a brilliant treaty mechanism, you face effectively zero tax on the distributions themselves. It's the exact same US account, but three entirely different financial outcomes depending purely on geography. Section 4. Rules for protecting wealth. Cross-border tax planning is non-negotiable. Look, if there is one universal takeaway from our briefing today, it's that cross-border tax planning is absolutely non-negotiable. Before you even think about relying on treaty protections, even in a haven like France, you have to ensure your distributions are considered qualified by the IRS. Step 1. You generally must be over age 59 and a half. Step 2. You must have held the Roth account for at least 5 years. If you take a non-qualified distribution, it will almost certainly be taxable everywhere, completely negating any treaty benefits. And step 3, because treaties contain complex provisions like the saving clause, and these rules naturally fluctuate, hiring a qualified cross-border tax professional is an absolute prerequisite. So as we wrap up our briefing in my office today, I want to leave you with this final critical question to mull over. Where will your retirement dollars actually end up? Are they going to fund your dream lifestyle in Europe, or will they be drained by unforeseen foreign taxes? The choice ultimately comes down to your preparation. Make absolutely sure you understand the local laws of your destination before you board that flight. Thank you so much for joining me for this explainer.